$120,000, which was a pretty good situation, to $4,500, which is not a good situation. And so we had a very drastic runoff. The other thing is the green line there is basically USDA numbers. And so one of the things you can end up seeing is that Kansas does generally follow U.S. numbers. Although if you look at where we are now, essentially USDA is not picking up this as wide, nationwide. However, if you look at probably the Midwest, specifically if you look at U.S. or Illinois numbers, Illinois, their net farm income for last year was negative $2,000. And so they actually ended up in a little bit worse situation on average as we did in Kansas. And so certainly there, and then if you look at USDA numbers, they suspect that 16 will not be as good as 15. In Kansas, we're probably going to end up maybe seeing a little bit of a bump up from 2015 to 2016, and it'll be a little bit of a bump up, primarily because of the good crop production statewide. Certainly the prices are quite a bit lower than they were last year, but the price is there. In terms of the other thing I think it's important to realize is people a lot of times ask, well, where's the sector that's making money? Unfortunately, there really isn't one right now. In terms of crops production, their incomes are down. In terms of the livestock numbers are down. And so right now there really isn't a bright spot in the Kansas agricultural economy. I think though the other thing that's pretty important to consider is that this is, not everybody is in the same boat, and there is a distribution around here. Looking at this graph here, it kind of gives you a little bit of a distribution in terms of those that earned more than $250,000 in 2014 were 15%. And so 15% of the farmers in Kansas in 2014 earned more than $250,000. 26% kind of earned in that $100,000 to $250,000 range, and that drops all the way to 3% lost between $100,000 and $250,000, and about 1% lost more than $250,000. So a very wide distribution. Again, just to let you know, you do have these slides in your booklet if you do want to follow along. But then when we went from 2014 to 2015, we ended up seeing a drastic movement of that distribution to the left. There still were some farmers that did very well last year. In terms of about 4% of the farmers in Kansas earned more than $250,000. But if you look at the other side, 10% lost more than 50 but less than 100. 8% lost more than 100 but less than 250. And 4% of the farms ended up losing more than $250,000. And so we had a drastic change from 2015 to 2014 to 2015. In fact, the net farm income number in 2015 was the lowest since 1985. And you start hearing numbers the lowest since 1985, or any numbers that end in the 1980s, it's not a good situation. Couple numbers here that kind of look at this. One of the numbers that is important, I think, to consider, and this is actually where we're in a fairly safe position yet, is this purple line that measures the debt to asset ratio. In the 1970s, we were kind of down in the 20s. Through the trouble of the 1980s, we went from entering the cycle of about 25%, ended up about 37% average debt to asset ratio. Then it's important to realize that we kind of hung in this 35% range all the way from the mid-1980s all the way to 2005. And so it's pretty important that Kansas farmers for a long time managed quite a bit more debt compared to assets than they are now. Then we got to the good times. Debt went down relative to assets quite substantially, and a lot of that was the run-up of the assets. We actually ended up as safe as we've been over this period of time. In 2014, where we ended up at 19.7%, and then we ended up increasing to about 23% over there. Probably the number that's most concerning is this number in red, and this is the capital debt repayment capacity. What this is it's saying, do I have enough income in order to pay my principal and interest? And essentially, so we take net farm income, we add on any off-farm income, then we end up subtracting off family living in terms of you have to certainly have your family living there. We also assume you're paying taxes, and so we take off any taxes. And so the rest that's left there is essentially to pay interest and principal. In terms of looking at this, ideally this number, and this is the red number axis, is going to be 100%. What that says is at least we have enough cash to pay off my principal and interest. In terms of looking at this number, we were kind of in this 150 range in the good times. Basically what that meant is we had 50% more cash than necessary in order to pay our principal and interest. In terms of looking at that from the good times, that began to deteriorate. In 2014 was the first time in quite a while that fell below 100%, and so we had 94%. That meant that essentially in 2014 the average farm was 6% short. Last year it fell to 16%. That means that the average farmer was about 84% short of earnings, meaning that they're going to have to take cash someplace else off their balance sheet in order to make those payments. The 16%, lowest since 1981. Again, not good comparisons with regards to that. And so this kind of summarizes what we covered in terms of the financial situation. And Michael is going to talk about what drove that farm income.
I don't. Okay, can you hear me? Are we picking up on the mic? Okay, now we are. I'll talk a little bit louder. So I have two microphones, which means what I have to say is twice as important as what Dr. Featherstone had to say. Okay, so can you answer the question, what drove the change in farm income? All right, for those of you who haven't heard me speak before, I don't ask a lot of rhetorical questions. I prefer to ask questions that I know you can answer. So the sooner that you answer them, the quicker we move on to the next slide. Smile. Just smile this morning. Okay, there we go. Hey. All right. So what drove the drop in farm income? What happened? Yeah, commodity prices. Where'd they go? In the tank. Okay? Commodity prices went in the tank. All right, so this drove the fall off in farm income. So that's what's been happening. Let's talk about what we think is going to happen going forward. So economists make weather folks look real good when we do forecasts, okay? But we've got a few bits of information that we can put together and try to come up with a forecast of where we think we're going to be. And one of the ways that we do that is we look at the futures market and we say, okay, what is that implying about our about cash prices for the next couple of years? So the trick to doing this, of course, is that you want to take that futures price and you want to subtract off a basis level. And we use 33 cents under for basis for wheat from Salina. Hey, that's better. Thank you. Now, is that the basis right now in Salina? Do you think Salina's 33 cents under? It's not. It's closer to $1.50. Okay? We've got a wheat basis problem this year that's adding insult to injury when it comes to the wheat crop. But we don't expect that basis to be as wide next year. We hope that basis is not as wide next year. And so we're using a historical average. So let's take a look at what that implies about the prices going forward. It doesn't push prices back up. Right now the futures market is just indicating a flattening of prices where they stand. There's no reason for them to push them up, and there's no real reason for them to push them down. So that's kind of where we stand. Well, if we take those commodity prices and then, well, let's see. If we take those commodity prices as what we think it's going to be, well, what potentially affects our forecast? The accuracy of the futures market is pretty, I mean, we think it encompasses as much information as possible, but let's take a look at what the futures market prices can do over time. Okay, so when I show this slide to some of the students at K-State, I say, so downward price trend, right? But there's been some peaks, so when you're marketing your grain, you just need to market it at the peak and then you'll be okay. Okay? And some of them in the room, yeah, okay, okay. And some of them in the room are like, yeah, right. Okay, so that's the problem, is that we have this overall downward trend, but we've also got a lot of volatility in it. So how do you know when those prices are going back up and when they're not? That's a problem. So a lot of volatility. What else affects our forecast? Well, this chart right here is the exchange rate between US and the Brazilian currency. Why do we care about Brazil? What do they grow? I'm going to get you to answer a question before I leave here today, okay? Yeah, they grow beans. And right now, given the exchange rates, they're looking at really valuable beans, and so they're planting as many as they can. In fact, what this is doing to U.S. commodities is the stronger our dollar is, the more expensive our commodities are. And so our typical buyers are looking for other places to buy their grain because it's cheaper in other places. This carries over even into U.S. buyers of grain. So this past summer, the Wall Street Journal ran an article saying that the Southeast U.S. poultry producers were bringing in beans from Brazil because it was cheaper to bring them in from Brazil than it was to bring them in from Iowa. Okay? So we've got a lot of things working against us right now. It's not like we haven't seen these commodity prices before. Okay? We've seen these prices before. In fact, they're pretty similar to what we saw in 2007 and 2008. The difference between then and now is our cost of production. Cost of production, these are just variable costs. You might call them cash costs. These don't include the fixed costs of land and some other things and depreciation. But this is the variable costs of growing these crops, and what you can see is that they've gone up significantly over the last 8, 9, 10 years, and that's what's making our profitability so poor, because prices dropped off very quickly, but cost of production hasn't adjusted to meet that. And one of the areas, for example, let's just talk about cash rents for a second, that does not adjust as quickly as commodity prices do. Okay? So prices have fallen, and we are definitely in a global market when it comes to being exposed to that kind of price risk. Cost of production has gone up since the last time we saw prices like this. And so this has implications for our ability to repay debt. And I'm going to hand them back over to Alan to discuss that.
Again, we had indicated that repayment capacity is pretty key, simply because that generates you the income in order to make the payments to the lenders, but also to invest, expand your operations, make other types of decisions. Essentially, you look at these numbers and you start panicking a little bit, simply because there's a lot of similarities to where we are now. Except where we are now, we went about 4 years it took us to get there. In the 1980s, it took us 2 years. From 1979 to 1981, repayment capacity fell from 153% to 16%. Here, we went from 149% to 16% over a 4-year period as opposed to a 2-year period. Two key factors affected that. The first was interest payments increased by 65%. Interest rates back then were probably 13, 14, 15, 16, 17%. And for those that haven't farmed for a long time or haven't paid attention for a long time, those interest rates sound unreal given where we are now. In some respects, the interest rate is probably one of the positive things that may make where we are now different than we were in the 1980s. The second thing was the decline in the value of farm production fell by 15.7%. We've probably ended up doing more than that, kind of where we were from the peak in terms of the value of farm production. Land values couldn't be supported any longer. Repayment affected. Again, this graph here basically just gives you the percentages in Kansas since 2011, went from 150 to 16%. Again, looking at the comparison with the 1980s, it's pretty close. The other thing I think that's important, and this kind of looks at the probability of default on the farms. The key thing off this graph is to realize that we're relatively safe. We are in a very safe position compared to where we were in the 1980s. And so in some respects, the safety is another thing, is that farms are in a very safe position going into this downturn. And so 1 or 2 years probably isn't going to be a major effect, but maybe 2, 3, 4, 5 years, if it would last that long, would end up being an issue. Again, I think the important thing to remember is there's a distribution. Not all farms are the same. In terms of some are much more profitable than others. Some are, their balance sheet is in better situations than others. And so there is a distribution around here. Repayment capacity certainly is key. 2016, while I think some incomes, and in fact Southeast Kansas, looking at the incomes, maybe bounce a little higher simply because there's more beans growing here in the state. If you look at what's going on in the western part of the state, where there's a heavy reliance on wheat and all the issues with the wheat basis, they're looking for a much more difficult 2016 than they were in 2015. But certainly 2016, while it may be a little bit better in parts of the state, it's not substantially better. Probably what we're most concerned about is if we go back to normal yields at these prices. And so probably looking at these in terms of the 3 years, 2015, 2016, and 2017, unfortunately 2017 looks the worst, at least where we are, if we go back to normal yields. Simply because prices, unfortunately, Kansas isn't going to move the world market probably too much in prices. And so we're going to need a drought someplace across the world, or we're going to need a huge increase in the global economy, especially in Asia, in order to bounce those prices up in 2017. The important thing is it can happen, but that's not the expectation. And so the expectation is that prices will be level, kind of in that $4 range for corn, probably in that $9 to $9.50 range for beans, and kind of approaching $5 for wheat over the longer term. Looking at crop revenue insurance, in terms of crop revenue insurance, certainly does a great job from yield, but the problem is that the prices adjust every year. To give a little bit of an indication there, I have an example here of soybeans, or corn. I'll go for corn first. Essentially, I'm just choosing round numbers, but let's say your APH was 150, you chose 80%, that would essentially guarantee you 120 bushels. In 2013, the base price was $565, and so at those levels, you would have $678 of coverage per acre. You look at what happened in 14, declined 565 to 462, then 462 to 415, then 415 to 386. And the price for 2017 is not yet set, but using the way that they calculate that in current futures prices for the December 17 contract, we're probably looking at a little bit more slippage in the corn guaranteed price. My estimate, if I had to do one, would kind of be in that 378, 380 range. But looking at this, farmers are managing 33% more risk than they were when they put in the 2013 crop. And so as you're putting in the 2017 crop, you're got to handle 33% more risk. Soybeans, soybeans in some respects is the bright spot in terms of if prices do not change drastically from where they are, we may be looking at a guaranteed price of about $10 per bushel. And again, kind of looking at that, that's kind of better than it was in 2016 for sure, and perhaps in 2016. In terms of seeing these numbers between corn and soybeans, thinking about what they're going to do in Illinois, Iowa, and Indiana, if you were farming there and looking at these prices, what are you going to think about as you look for your 2017 crop? You're going to probably see a lot of beans. And so certainly that may be some thoughts with regards to how you want to do some marketing strategies in terms of if there are possibilities to lock in some profits by pricing or forward contracting. That may be something to consider, simply because I think farmers respond to price incentives, and the price incentives right there are soybeans. We'll also look at wheat. Wheat is a very ugly picture in terms of essentially the crop that just went in the ground, went in at a 459. Actually, the 2018 crop that'll be planted in the fall of next year actually bounces up a little bit, but essentially you're looking at about 50% more risk. And so essentially, this is also one of the reasons the state economy is in the position it is, simply because a lot of wheat is grown west of Highway 81, and you can kind of look at what's happened to the position of the wheat farmer. The other thing is there's a safety net. Certainly the safety net is there, but unfortunately the safety net is being lowered at the same time prices is going down. And so again, it's kind of not a good picture in terms of usually when there's more risk, you kind of want that safety net pretty solid. But the way the programs are working, unless you're in PLC, that safety net is dropping at the same time incomes are dropping. And you can see very relatively low PLC enrollment in Kansas. Earlier in the price, and there will be prices from time to time from a marketing perspective, those opportunities aren't really there. Essentially, probably soybeans kind of has the brightest outlook for 2017. Probably going to take wheat into 2018 to rebound. Whether or not we're going to have LDPs certainly is an issue. Some of the wheat that they've piled up in western Kansas, they're not anticipating moving that until 2018. And so those piles out there, maybe they're through the summer all the way into 2018 before some of those are moving. And so this, we'll let Mykel talk about how this is going to affect it.
And Alan Featherstone, also known as Vanna White, will be advancing the slides for me this morning. We're going to have to get you a sequin dress. Okay. Thank you. Can't move on until he smiles. Okay. So this is a chart of Kansas state level land values going back to 1950. Now I know that land values vary across the state, certainly, but when we look at a long-term trend, it's okay to use these state level values because they give us a pretty good sense of what's going on. And what you can see here is that we've had two big run-ups over this 65-year period of time. And the first run-up was in the mid to late 70s. And it was in response to the really profitable farming that we had, right? The returns to farming. And then it crashed, okay? So one of the problems with the 1980s, one of the reasons that we started to see land values fall was that, well, the profitability was low, but we also got to a point where folks had to find a way to be able to pay off debt, to be able to keep things moving, and some land got sold as part of that process. We don't see a lot of land turnover in the state on an annual basis. It's not like, every piece of ground is available for sale every year, right? So it doesn't take a lot more land up for sale to really drive those prices down, even in a local area. So that's kind of what happened. Now take a look at this run up that we're just coming off of more recently, and it's even more dramatic, honestly, compared to that 70s run. Now these are real prices, not nominal. So we took out inflation, So that is to me, it's more striking how fast we've run up land values over the last 10 years or so, and how we've seen them they've already started to fall off a little bit. And the question becomes, where do we go from here, right? Now, if you get a PhD in economics, what that allows you to do is take a red pen and make lines about where you think land values will go. But you have to have a PhD in order to do that, okay? So here's 3 scenarios. One of them is we just stay flat, right? And if commodity prices were to recover today and everything was to be okay, maybe that would happen. But that's not exactly what we're thinking, and it's not what we need to be preparing for. The second line is going back to a growth rate that I would say is a little more aggressive than perhaps that historical growth rate that's at the bottom, that bottom red line. So we could go back to that level where, you know, we're at a new, more aggressive growth rate, and that's possible. Or we could go back to something that would look a lot more in line with that historic norm. And to get to that point, we're going to have to see a pretty strong drop-off in land values. So we've done some research using about 40 years worth of data. Oh, sorry. Okay, yes, we did some research using about 40 years worth of land values and returns to farming for Kansas. And what we're trying to do is figure out, okay, if we project forward what the returns to farming will be over the next couple of years, what does that do to land values? And so here's those projections going forward, and you can see that income is being projected right now at just shy of $50 an acre. That's that red line. And that's based off of what we're projecting for returns to corn, beans, and wheat. And what happens here is that if we keep that net farm income at just shy of $50 an acre, and we go forward with that for the next couple of years, well, the long run land value that reflects that level of profitability is about 50% lower than where we were at in our peak in 2015. So that means that if we stay basically right where we're at today and we carry that forward for the next couple of years, we could see land values fall off by about 50%. And to be honest with you, they've already fallen off, I think, a total of, was it 12 or not? 10, 12%. So we're already on our way. The question there is, okay, so how fast does that happen? Right? How long does profitability have to stay low to get back to that point? And that's a trickier question to try to answer. That one, again, comes back to how many times that we see farms having to liquidate that land and having to sort of force sales. When I visit with appraisers and farm managers and some auctioneers from around the state, for this whole year, for 2016, what they started seeing at auctions was a combination of good land that was still selling at a pretty good price, but they started seeing more and more land, typically lower quality, that was not meeting reserve, which meant that the seller had a price that they were trying to get, but those last bids didn't get to that point, and they didn't let it sell. They said, okay, well, if I can't get the price I want, I'm not going to let it sell. Well, that's an option that you have if you're not being forced into selling that ground, right? But as soon as you have to sell that ground, not meeting reserve isn't an option. So we know that the demand for land has softened quite a bit, but how far it's softened, we won't really know until we start to see that land actually trade hands. Okay? So land values are a concern. We certainly know that the profitability does not support where land values are at today. And to be honest with you, the rental rates probably don't support where we're seeing profitability today, and we'll talk about that a little bit more in another section. And so in order to get these land markets back to historical norms, we're going to have to see some declines, and we've already seen them. So it's just a question of how much more and for how much longer. But as soon as you start seeing land values fall, that makes the bankers in the room nervous, right? Because it's not about whether or not you're actually going to sell your ground or trying to buy ground. It's more about the value of that as collateral for your loans, right? And so that's the thing that, your ability to borrow, your ability to get operating notes is going to be based on the value of your assets. And we're looking at the possibility of the value of those assets across the board falling quite a bit. So on that happy note, I'm going to pass it back over to Dr. Featherstone.
We're going to change gears here and move into looking at the debt position. Certainly, we saw that debt-to-asset ratios were decreasing over time, but was that due to the numerator, the debt decreasing, or was it due to the denominator, the assets increasing? Basically, looking at this picture, the average debt level has went up. In terms of in 2005, 10 years ago, average Kansas farm had $320,000. In 2015, that average Kansas farm had $570,000 of debt. In terms of looking at it, certainly we've seen a run up here quite substantially over the last 3 years. From 2012 to 13, we increased it by $40,000. From 2013 to 2014, we increased it by $47,000, so that's up to $87,000. And then last year, we increased it by $23,000. And so looking at that, over the last 4 years or 3-year period, we increased the debt level by $110,000 per farm. Looking at that, 110,000 divided by 400,000 roughly ends up increasing 25%. And so we have seen substantial run up in debt. In terms of where that was, in 2013, that change in debt, essentially most of it was at the current side. And so we may have been buying equipment, but if we were financing it with short-term debt. If we were buying land, we were financing that with short-term debt. Or the other possibility is that prices, when you pulled off the 2013 crop, were they good or were they not so good compared to what you had seen in 2012, 11, 10? I don't know if you can remember back. The fall harvest of 2013, the prices weren't very good. And so a lot of producers said, you know, I'm going to hold on to that crop and hope that the prices increase into 2014. And so at the end of the year, they had to essentially finance that simply because you had to finance those inventories into the next year, or possibly they didn't have profitability. But from 2013 to 2014, was that a good strategy to hold those crops and sell them into 2014? That actually was. That was the right strategy to do. And you can tell that because the 2014 income was pretty good. And so from 2013 to 2014, those that ended up holding off selling and selling in 2014, they made money because prices bounced up pretty good. There were opportunities to sell. So that worked from 2013 to 2014. So from 2014 to 2015, we said we're going to try that strategy again. And so now we took 80% of that $47,000 also on the current debt side. Did that work so good from 2014 to 2015? No. Not only did the prices not go up, they went the other way, they went down. And so the perfect strategy for 2013 crop was exactly the wrong strategy for the 2014 crop. And that's what makes farming so difficult, is that the strategies from one year to the next change such that when you look back, the strategy that you used wasn't there and may be totally different. But the key thing is that this is beginning to indicate that we're building up some current debt there that is important. In terms of looking at this, can you get a fixed rate on your short-term debt, a fixed interest rate? Not usually. I don't know really anybody that would lend short-term for a fixed rate. Usually it's going to be your intermediate and long-term debt that you can get the fixed rate on. And so given that, the Fed just this week increased the interest rate by 1/4 point, is that current debt going to be subject to that 1/4 point interest rate increase? Yeah. And so that's one of the things I think that's going to be very important, is looking at that trade-off with regards to that. From 2004 or 2015, and this should be Changing Kansas Farm Debt 2015, essentially the current debt was $14,000, long-term debt was $13,000, and we actually reduced the intermediate debt a little bit. And so certainly that picture changed. Debt has increased. The majority of it has been in current liabilities. Those current liabilities, in some respects, that interest rate is going to fluctuate with the economy. There is some indication, however, that farmers are beginning to refinance some of that current debt, moving it more into intermediate or long-term debt where they have more ability to pay that off. But probably more important is it does give the farmer the opportunity to put a fixed interest rate on that, such that if that interest rate increases, they've insulated. They're going to pay about 1.5%, maybe more for that, but it is an insurance policy such that if the U.S. economy gets going, the Fed begins to lose control of inflation, which I'm not saying is going to happen, but it could happen, such that interest rates start increasing, at least that portion of the debt would be at a fixed rate such that that would not be susceptible to interest rate changes. The other thing that's important to realize is how many of you would be pleased if the K-State men's basketball or women's basketball team would shoot 89% on their free throws for the season? How many of you would take that? Pretty much everybody would take that. In terms of the important thing to realize is you may be a pretty good farmer. You may be saying, you know, I'm average or above average, so I'm not sure what the issue is. The important thing to remember is sometimes we look back to the 80s and it's kind of walking uphill both ways to school that my dad did when he walked to school in the old days. It was uphill both ways. I've never figured out how he did that, but he said it, so it had to be true. And so essentially, the important thing to realize is that during the worst time you could be lending from a national lending perspective, at least on land loans, and this is information from an insurance company that lends on land, the worst time they could have been lending on land was 1977 through 1980. They ended up hitting on 89% of the loans they made, 11% they didn't. Some of those were pretty ugly. Some of them hit the rim, hit the backboard, came back, hit the rim, circled around, and finally dropped in. And so as a parent of a kid making that shot, you're kind of on the edge of your seat, but it finally went in, so things are great. And so that's kind of how we ended up in the 1980s. But the key thing is roughly 11% of those loans going bad killed the sector. And so the important thing is that the average is not going to drive the bust. It's going to be the tails. And as Mykel indicated, there isn't much land that trades hands in a year, 2 to 3%. If all of a sudden that 2 to 3% went to 4 to 6%, doesn't sound like a very big increase, but how well did we deal with twice as much wheat production in western Kansas? Not well, in terms of we ended up with a lot of piles. And so doubling the volume makes a big deal, which is not a very big percentage. And so the key thing I think that's important to remember is the tails drive the average. And again, you hear all these stories about there's all kinds of off-farm investors coming in and buying farmland. The most recent numbers are 80% of buyers of farmland are other farmers. And so the local dentist or the hedge fund out in New York coming in buying land, they only make up 20% of the buyers. 80% of the buyers are still farmland. We like to have stories in the Wall Street Journal about all these non-farm investors coming in and swooping up the land, and it's probably bigger than it was, but it's still only 20% of the market. Debt to asset ratios, this is a positive situation. We are in a relatively strong position, especially compared to the 1970s. We're about where we were. Probably the only disappointing fact is we went through 2015. At the end of 2014, we were much safer. Now we're about where we were in 1979. Again, the important thing to realize is that there's a distribution there. And so certainly these individuals that have very high debt to asset ratios, in some respects, are probably going to end up driving how well we're able to weather this storm. If those end up in situations where there's forced land sales, those type of things, it's going to probably be more difficult than if we can essentially manage through that in another way. One of the ways to look at this is what I ended up doing is I took the balance sheets on all of these farms that we have available to us through the Kansas Farm Management Association. And I said, what happens if I decrease land values by 30% on each of these operations? What would their debt to asset ratio be? In terms of looking at this, and I did it by 10, 20, 30%, you can end up seeing that the picture gets worse in terms of the distribution ends up shifting to your right, and that's not what you want. But the key thing is we still end up with a 30% drop at a 27% debt to asset ratio. What were we managing in the 1990s, early 2000s? What was our average debt to asset ratio? About 30%, 35%. And so the thing is we can probably survive a 30% decrease in land values. It's going to probably take more than that to really end up getting us in a difficult situation. Again, repayment capacity is pretty important, and we're going to talk about that a little bit more later. 2016 is probably going to erode working capital for a number of farmers in state, probably not so much in southeast Kansas, but certainly for other parts of the state. 2017, again, is probably going to be more troublesome than what we've seen in 2015 and 16. Again, I still think 2016 is going to be a difficult year. I don't think anybody's really thrilled with where 2016 is going to come out. For some individuals, it'll be better than the previous year. But 2017, I think, is really going to be pivotal. And again, we are at levels that we haven't seen from the 1980s. Again, given where we are, there are some producers in Kansas that are going to have pretty difficult situations to deal with before they put in the 2017 crop. If we have another year of that, there may be a bigger segment that may end up having difficulty before we go in. With that, are there questions? The question is, are the buyers in Kansas of land about the same, 75 to 80% farmers like Iowa? We don't have good numbers on that, but my suspicion is that yes, it would not be a lot different from Iowa compared to Kansas. Typically, other buyers of farmland, and it'll vary regionally, tend to be other farmers. So that's probably a pretty good number. There might be a little bit of range on that, but especially once you go to regions of the state, certainly that's going to be the situation.
How farmer friendly is the new administration going to be?
The question is, how farmer friendly is the new administration going to be? You have the plan. Why don't you answer?
Yeah, in terms of this is, it'll be interesting to see who ends up being Secretary of Ag. In terms of if the senator from North Dakota ends up being Secretary of Ag, I think she's going to understand Great Plains agriculture. I think that would probably be a positive thing. In terms of nobody knows who that's going to be. Probably in another 2 weeks, that's going to be revealed. In some respects, you hear a lot of rhetoric about trade and whether or not we're going to get into trade wars and things like that. I tend to take more of a philosophical type view that the campaign rhetoric is usually extremes and then things go back more to normal levels. One of the things I think that's pretty important to realize that if you look at the population increases, of that roughly 2 billion person population we're supposed to increase between now and 2050, 1 billion of those people are going to be in Asia, 1 billion of those people are going to be in Africa. Does Asia have a lot of opportunity to expand agricultural production? If you go over there, they farm on mountains, and I mean they farm on mountains. It's unbelievable. You go up the hills and there's stuff that I'd be worried about falling off the hill just walking up, and they have plots of food and wheat or rice or those type of things. And so there isn't a lot of opportunity for them to expand land mass or in some respects increase their production. Africa has potential, but they're really messed up from a political standpoint. And so while I think they will, I think you're looking probably at 30, 40 years before that occurs. So the production is going to be in the Western Hemisphere. It's going to be North America. It's going to be South America. And so that's not where the people are. And so you're going to have people that are hungry in Asia, in Africa. You're going to have food production in North America and South America. And so either those people are going to have to move to these countries, which I don't think politically is less problematic than trade. I think immigration is more of a difficult issue politically than trade. And so my view is that we're going to end up trading. They're going to end up buying food from where it's produced. And so from that perspective, it's there. In terms of where they'll be in terms of farm policy, it'll be pretty interesting in terms of my guess is that they will not. I had the opportunity to be on a panel with Senator Roberts and Chairman of the House Ag Committee, Conaway from Texas, and both of them were adamant that they would not open up the Farm Bill. That was in September, and a lot has changed from September. My guess is, though, that instead of opening it up or re-litigating the current Farm Bill, my guess is that they'll go ahead and move with a new one. And so, but where that's going to end up, it'll be pretty interesting. They're well aware that things aren't working in terms of, I had a chance to speak to Senator Roberts before the presentation, and one of the things he said is, you know, I hadn't heard anything about the agricultural economy until about July. When July hit, my phones and my staff started ringing off the hook with regards to what was going on in the farm economy. And so certainly I think there's awareness in Washington that there's issues there and that something's going to have to be done in order to watch it. I'm not sure where they're going to end up going. My guess is they'll rely on crop insurance a little bit. I don't know where it is, and again, we see the problems with crop insurance in terms of how that changes from year to year, but that's kind of in the mindset, and so so it's a very open question. Hopefully I've danced around your question long enough, but I don't think I don't think we're going to end trade. I just think that rhetoric has probably been overblown.
When we started trading with Russia, before 1980, in the 70s, we could not raise enough grain to send to Russia. And then when they did that embargo on Russia, it caused that 80s to happen to us. Those farmers don't remember that's what caused that to happen. And when we go back and start trading, Russia was a great person to trade grain with. We loved it in the 70s.
Yeah, in terms of the question was, in the 70s, we did a lot of trade with Russia. Will we go back to that? In some respects, and there's a lot of political discourse going on with Russia. The big thing that's changed with Russia is now a grain exporter. And so the thing is Russia is producing excess grain. Probably the big hope, if trade would open up with Russia, would be moving livestock products in there. Probably most chicken, in terms of used to be a big chicken importer from the U.S. Perhaps beef, and so we may be able to move beef and chicken in. But in terms of the grain, Russia has improved their agriculture such that they're now an exporter of grain, and so they're more of a competitor there than a purchaser. And so unless they would end up with a situation where they ended up with such a drought, I don't think that's a possibility for the market. I think our markets are going to be in Asia, the Middle East, and in Africa to some extent.
When we sell grain to China, do they charge us a tariff like we export?
Yeah.
Do we pay tariff?
Yeah, the question is what is the tariff situation when we export grain to China? I'm not sure. Do you? We'll see if we can find out yet today. And
Trump alluded last week that when we import stuff from China, we don't get it like goods and services, and we export stuff. There was, he kind of alluded that there might be a tariff on it. I was just curious.
There is a tariff on some stuff. I don't know if there is on grain, but probably the big issue with regards to grain in China, and they're actually changing this, but if you would grow corn in China, you would be guaranteed for the crop that you put in 2016, $10 a bushel. How many of you guys could make money at $10 a bushel corn if you knew when the crop in 2016 was going in, you were going to get paid $10 a bushel for it? Yeah, you guys could all make money and we wouldn't be here. You would be having fun instead of thinking about an agricultural economy that's struggling. But the thing is China now has realized that they can't continue to do that. And so they're beginning to back that down. And in some respects, I think that's a positive as we look at China, simply because they've realized that they can't, especially at prices for corn of where they are, they're subsidizing $5, $6, $7 a bushel. Well, they can't continue to do that because it's going to break their bank. And so they're actually going to start reducing that, which in some respects I think is going to allow opportunities for other commodities to go in. I still think they're going to be political in terms of they're going to end up finding stuff that they don't like to keep the market on edge. But if their incomes and their economies continue going, their big issue is their middle class is expanding rapidly. And so they're ending up going from a grain-based diet to more of a protein-based diet. And so that's one of the things that happens when people get into a middle class. I always ask people to think about when they were a college student, and I like doing this with the college students. I indicate how many of you are going to have the same diet in 5 years that you're eating now. Well, every one of them isn't going to have the same ramen noodles, 17 ways of preparation in order to do it. They end up diversifying their diet. You don't need to tell that part of the story. They have to keep that middle class happy.